Hello, how are you doing? Welcome along to FTUK's weekly catch-up live stream. It's Friday, June the 13th, Friday the 13th. Not superstitious at all. I am confident and sure you've had a good week in the markets and your trading has been going well, whatever you've been trading, wherever you have been trading it. And yeah, we're going to do something a little bit different today. I want to talk about trend lines, a very basic form of technical analysis, and you'd be staggered at how much there is to actually say talking about trend lines. So hopefully this is going to be something that maybe you've not considered before. But before we get into it, please do scan the QR code there and go join our Discord community. Speak to Reza. He'll sort you out with all of the latest things that are happening at FTUK. And of course, please do subscribe to our YouTube channel, which is growing all the time. In fact, all of our social channels are doing well at the moment, and it's the best place to find out all of the latest offers and the giveaways and the competitions and all the stuff that we've got going on at FTUK. So it is definitely worth joining in on that. So trend lines, we'll jump straight in. I've divided it into 9 key points, and we will try and go through it relatively quickly because I can talk around this subject for forever. Traders are always looking for simplicity. And that makes sense. Traders are always looking for the simplest strategy, the simplest technique, the simplest form of chart analysis, the simplest way to make some money in the markets. Well, I got to be honest with you, it does not get more simple than drawing a straight line on a chart. And all of the trading applications will give you the ability to draw a trend line. But do you know, if you actually really thought about what a trend line is, what it does for you, how we can actually use it in the market? Well, essentially, trend lines are tools that we use as traders for forecasting. They are a leading indicator in that sense. We use the current price action to make some sort of a projection in the future. So there is quite a lot when you start to look at what that can potentially mean and how you can use it as a trader. There is quite a lot that you can say around the subject. So I've divided this into 9 points. First up, let's define what they are. Well, everybody should know what they are. Everybody thinks that they know what they are, but can you define it? Well, in theory, a trend line should be an angled line that in some capacity contains the price action at the extremes of that price action. So in its simplest format, you could say that you've got a sequence of a higher high and then a higher low, again, a higher high, higher low, and there we go, and this is going onwards like that. So by connecting these points together, say for example it's like that, connecting these points together here, we've contained our price action. Do that on the other side as well, and we have contained the upper side of that. So we have got a trend line in place, and that is giving us a sense of forecasting into the future, the direction of the market is going. Okay, very simple concept. Everybody should know that. It's not difficult to understand. So what they do as well, though, is they allow us to segment the price. They allow us to give us a sense of perspective, and we can use trend lines themselves as a very, very basic form of a filter. Now, what do I mean by that? So take this as an example. You have a price action, you have a lot of price action in front of you, and you've got major trends, you know, sort of like meshing together with minor trends and that type of stuff. Sideways markets against some markets that are moving higher and markets that are moving lower. We can use trend lines to isolate areas of price action of interest. So what we do is, looking left, you basically eradicate the actual the extremes of the prices somewhere else on the chart. That in itself is very good for isolating the current market that you are working with. So that the fact that you're just working with this swing point here and that swing point there gives you a sense of just making, sort of weeding through the haystack, just filtering a little bit. That in itself is very, very liberating if you actually get into the habit of actually doing it on a regular basis. So they a sense of perspective, and we can use them as a filter, but also they can give us a sense of proportion and a sense of direction, as in how wide the market is and which way the market is going. Well, again, this is not complicated to really understand. The market gives us a sense of direction. This trend line, by connecting these 2 points together, is telling us that the direction of the market is potentially up. We should be in a bullish market. If you're on the opposite side, the market would be going down. The trend line is showing us that the market should be moving to the downside. That's basically how that works, yeah? They also give us a sense of proportion as well, because the width of that as well is telling us how volatile the market is. It gives us an idea of how wide that price range is going to be as that trend starts to form. So again, the trend line is very useful at helping us understand and quantify that as traders in our minds. So This is where it starts to get really interesting, because trend lines also, because of their forecasting ability, they also have they give the market a sense of memory. And you will be staggered at how often prices return back to old historic trends that have now broken down and have gone somewhere else. And that basically looks like this. So if you look at this example here, you've got a situation where we've got a downtrending market, we've got a trend channel drawn around it, and the market is broken free from that and then gone off in another area, completely disrespecting that trend once the market has broken out from it. But look what happens later on historically. The market comes back and it still respects that area in the future. Now, this is not going to happen every single time, but you'll be surprised how often the really old trend lines that you drew come back and have some sort of an influence on the price. Why? Because we're all human beings using the same tools to do it. So therefore the market comes down and meets that line some point in the future, and therefore it acts as an area of support simply because of the fact that the trend line was drawn on originally historically. So it is fascinating how price and time can be brought together by a simple trend line. Now, if you study any of W.D. Gann's work, who is fascinating, very confusing, but fascinating, his theory was that when price and time square, a reversal is inevitable. So he had various different tools that would do something similar to this, but essentially a trend line can actually do that. Now, I'll show you an example. And I admit I have cherry picked this one, but all I want to do is illustrate a key point. Now, if you look at this chart here of Bitcoin, it's kind of spooky how these things work. We've got a really clean looking trend channel here. This is a 4-hour time frame from a year or so ago. This is 2024, June 2024. The trend channel itself is working really nicely. Of course, you get a bit of ragged price action around the edges and some breaks. And then the market completely says, okay, this trend is coming to an end and we're going in another direction. And off the market goes. But then look what happens ages and ages later. Look how well the market respects the trend line, comes back to respect it. And not only that, but respects the middle area of that trend line as well. Now, when you get into technical tools like Andrew's Pitchfork, which is an absolutely fascinating form of technical analysis, it's built around a concept called median line trading, all of this starts to make sense. So trend lines are then extrapolated and built into something that is just far richer, and that is a rabbit hole if you want to sort of like really sort of get into the weeds of understanding how trend lines can be impactful on price action. But you can see it there. The market has memory. The market remembers that old trend, and at some point in the future, it then respects that old trend line. It's very, very fascinating the way that actually works. Let's move it on. Point number 6. So trend lines also show us what is currently considered to be high or low given the current trading environment. And again, this is where we can start to be a little bit more advanced in our thinking of how we understand trend lines and also trend channels as well. And that is that when you've got a market that is giving you a certain range, it's got a sense of what that market is actually working with. What we've got is a sense of, at these upper areas of this trend line, the market is considered to be too high. The elasticity of the market is stretched too far, and we're looking to trade a reversal. When the market comes back down to support, the market is considered to be potentially too low. It's going to find support. The elasticity of the market is stretched too far, and it's going to go back in the other direction. That's the quality of how trends themselves form, because they're never just one straight line. They're always a range of prices that has got a lean or some sort of angle on the price action. So that in itself is a fascinating insight into how a trend line can be used to give us a sense of high or low. Now, in its basic format, and you've got to use your imagination a little bit to think in this concept, but it is useful to do it, and that is very similar to the way that overbought and oversold indicators work. So an RSI is obviously going to give you a much more sophisticated view of when a market is oversold relative to its current period of candles that make up the RSI. But in and of itself, the trend line itself, the trend channels, can still give you that kind of a gauge. So you could argue that once we've forecast forecast into the future, if we do have that trend line, are we looking for topping type behavior, whether that's candles or another format or another setup or something like that? It's giving you that. It's considered to be too high for that uptrend. And it's the same on the opposite side of that. We meet support and we're then saying that the market has gone a little bit too far and it's oversold and it's considered low for the current trend. RSI, of course, is going to do, and a whole host of other momentum indicators are going to give you that in a more accurate picture, but it just shows you, once you start to unpick how we can frame a trend line and a trend channel, how many use cases you can actually get from it. Really fascinating stuff. So at its heart, a trend line is allowing us to forecast price action into the future. That in itself is the most simple form of technical analysis. And what we're saying is that any trend line here, by drawing the trend lines out, we're saying that in theory, the market should find that support point at some point in the future. If such an event occurs, that price should return back down to it. It's a very simple concept, and that is the primary way that most people use trend lines. Also, they show us the trend in price, but they also show us and demarcate in the price action when that particular market state, when that trend might potentially be coming to an end. So what do I mean by that? Well, this is where we start to think of trend lines in terms of volatility, because as you can see in this example here, you've got a breakout. The market has respected the trend lines all the way up, and then all of a sudden something in the market changes, something else happens, momentum changes, and then bang, the structure breaks. The market bends the structure, it breaks the trend lines, and then we're off in another direction. That in itself is showing us a change. It's giving us new information, which the trend line is now saying, okay, this is now no longer valid, something else has occurred. That in itself is immensely useful. So you can start to see just how many things trend lines can actually help us with on a day-to-day basis. Very, very, very cool indeed. Now, I'm not saying that you've got to chase the price on this. It's not about front running, but the point is it's helping. The trend line is showing us that change in momentum is indicating very clearly that something has changed. And then you can obviously question that. Is that a news event that's happened? Is there something else that I've not even considered that is now happening in the market? It's a very, very cool use for trend lines. Lastly as well, and this is it's probably more of the advanced type of ways of thinking about what trend lines are doing, and that is to understand that they are in themselves a very, very basic form of risk and reward. They're a tool that we can use to compartmentalize how we measure risk and reward in the market. Okay, well, what does that mean? Okay, well, this is where we're starting to get into things like standard deviation and how basic finance works. And that is that when you're at extremes, that is essentially where markets are saying that's where risk is. Yeah, that's where people place their stop loss. Yeah, that's where people look to get involved at extremes of moves. Why? Because most people will have some sort of sense of counter trend trading. Yeah, the market moves to the extreme, it then tops out, it rotates back in. So that's where risk takes place. That is where our risk is. Whereas the middle ground, and that's the same at the top and the bottom, but the middle ground is then considered the return. And this is where things like moving averages come in. So as the market oscillates, let's just draw that on a diagram. So as the market's oscillating, what we're saying is that risk is here. You may be looking to take a position, you may be looking to counter trend against it, but the middle ground here, just draw that in as a dotted line, is where we would consider the return to be. So a classic way of like trading Bollinger Bands is that you people look to sell the upper band at the top, and then they'll look to trade back into the middle. So in its basic sense, trading with trend lines could mean that you're a buyer down here, and then you're looking to take that profit somewhere in the middle. There you go. There you've got your risk and you've got your return. It's the same function as how people use moving averages in mean return type strategies. There's no difference. It's just that we're using trend channels and we're demarcating the middle ground of a trend channel as helping us gauge what that actually is in the market. Very, very cool indeed. Now, let's move it on. How do you actually draw trend lines? Okay, well, it sounds simple, doesn't it? And you'll find that there's lots and lots of different ways that people consider this. There's lots of different ways that people look at drawing trends, drawing trend lines on a chart. Well, essentially, you need two starting points. You need something to start with. People will always draw them differently, but there are a few simple rules that we can apply that we always use. And the first thing is, in uptrends, we always go from underneath. We always look for the market to be supported in an uptrend. So that is where we define our trend line from. Whereas in the downtrend, it's always above. Okay, well, how do we qualify whether we know a trend is actually taken place? Well, you can see we've got 2 points here, point 1 and point 2. We can connect those 2 points together and connect in the future. And by definition, we're saying that is where we should find support at some point in the future. But how do you qualify that? And this is where you can start to think more algorithmically about how a trend line can be used to help define a trend. And that is to use some sort of other junction to help you understand. So my point is that how do you know point 2 is point 2? Well, what you can do is qualify it by looking at the way that it bounces. So say, for example, in this example, this is how I would interpret the definition of defining a trend. That is that the point that led to the first point that the swing point that led to where you drew that first point, once that has been superseded after the second reversal, that is when we can start to think this might be an uptrend. You get the idea, yeah? So that is when, until that happens, you don't know, because the market could bleed out the other side still, and therefore you're just constantly just moving your lines, you don't know how to qualify it. That is a way of qualifying it. And when you get into algorithmic trading, this is the kind of thing that you can program, and you can say, well, there is a trend here, yeah? And certain people, what they will do is that they will use this kind of basic way of compartmentalizing price action to basically define their trend and then build their strategy around it. So it's a very useful way of doing it. So once the price has bounced and it's taken out the previous high from the first swing, then we could start to say, okay, is this an uptrend? Okay, so that then basically qualifies our analysis of saying this is a trend line by saying that from that point there, when the market returns back to our forecast, we should be looking for it to act as support. Yeah, we should be looking at that point in the future now as being our trade point, and that's frequently why you'll see the third touch. You often get a lot of manipulation around it because it's where people will start to take positions. Yeah, so it's very strange how these things start to inform each other. Yeah, because we're all human and we all use these kinds of things to actually help us make a decision. And if you're doing it, someone else is doing it as well. So you will find that quite often that initial touch, you'll find some ragged price action out at the end of it. Maybe it won't respect it on the first touch. Yeah, and it's trying to sort of like stop people up because people will be taking positions, finding whether they're going to place a stop loss. Yeah, and some people will have a strategy where their entire strategy is they just take that first bounce because that's the only way that they can find a reason to actually go into the market. It's very, very, very cool indeed. Yeah, but the key point is to always remember that from an uptrending point of view, trend lines are always underneath. You don't draw it from above, you always draw it underneath. You draw the underneath first and then you project forward for the channel at the top if that's what you're doing. It's very, very important to do it in that order. It's one of the rules that I would definitely say is the most important. The opposite in the case of a downtrend. So we're looking for the swing points at the top on the upper side. They will demarcate our initial areas that we're going to work with as a trend, and then we will then project down from that angle to create our trend channel if that's what we are going to do. So when I drew that example on the Bitcoin chart, let me just go back to it over here. You can see it there when I was drawing that in. So I would draw it there, draw it in from the, I'm looking here. In fact, let's just draw it in again, shall we? Why not? I'm looking here, there, like that. And then bring that down. And that's demarcating my trend. It's that relationship there. It's not this relationship here. And that's very specific for a downtrend. Let me just go back to my slides. Always too many buttons, obviously. So remember this very, very simple rule. And this is the strength of your trend. The more touch points that are respected within the interaction of your trend line and the actual price action, in theory, the stronger the trend is supposed to be. So the strength of your move can also be informed by how well that trend is respected. But of course, the old phrase is that markets always break down eventually, and a trend is your friend until it ends, and all that kind of stuff. But what that does mean is that the more touch points that you get, the stronger that trend, the more manipulation you get as those extreme points in the price action get interacted with. Why? Because more people are seeing it. If you're seeing it, everybody else is seeing it as well. And the algorithms see it because they know how to define it as well. So you do get a lot of manipulation around that. And as the trend starts to develop, you'll start to see that manipulation takes place more and more and more, which is why, I mean, if you look at it on here, let's just go back to the Bitcoin chart there. You can start to see it. Probably not the best example, but it'll do for now. You see that how well we're respected. Look at that, and you start to get those later interactions with the extremes of the trend channel. Yeah, you get more manipulation, more bleeding out the edge of it. It's still trending, it's still going there. Now, what you can do, there is no law against it, or there's no rules against it, and that is that you can then update your trend lines to compensate for future price action. That is a thing too as well. So this is where your own interpretation and practice is always going to be super important to get right, that's for sure. So yeah, it is it's a very, very cool it's a very cool subject, and as I said right at the start, once you start talking about a simple line, it's quite surprising how much information you can actually garner from it. Now, trend channels, I mean, I've talked about trend channels the whole way through, but these are essentially the angled version of having two trend lines on a chart. Now, ideally, if you're working with a trend channel, you don't want them too extreme. You want them sitting at around about 45 degrees. They're gonna be the stronger types of trend channels that you're going to work with. And as I said before, in an uptrend, always work from below to above. So you draw in that initial support and then project on the other side. If you're in a downtrend, it's the opposites, and then use that way, like I showed you on the Bitcoin example. That is very, very important to do. And you're looking for the price to bounce. Some people will trade that, and that obviously gets into the mean reversion way of doing things, as I was speaking about before. So, how do you actually trade them? Oh, well, there's different ways. You can obviously be a seller of the tops of trend lines and a buyer of the bottom of the trend line. That is a classic way of doing it. You can use them in multiple ways. I personally wouldn't trade off them, but I think they're very useful tools to help you build into your strategy using other reasons. I would say trend lines work well on bigger picture timeframes when you're then drilling into the smaller timeframes using candle analysis, or even you're using your ITC techniques or Fibonacci or something like that. But the classic way, if you do want to trade with a trend line, is to trade the breakdown. Why? Because you tend to get fast price action off the back of it. Yeah, so any market that is breaking down, as you can see here, once you break that structure and you retest it, if you are breaking down, then that is the classic entry. So you will find, in the same way that people will trade like a head and shoulders patterns from a trend line point of view, you will find that most people will try and get short on that retest, and then you would probably use the height of the trend channel itself as a reason to project to the downside, looking for an exit. But that is the classic way of doing it. You'll find lots of information on how you can actually trade these kinds of breakdowns, and you can pyramid in your positions, all that kind of stuff. But in its most basic format, that is the way that is supposed to work. So if you look at this example here, I've got it. And again, this is cherry picked, but it does illustrate the point very, very nicely of how well these kinds of things can work. And this is a price chart, a 4-hour price chart, again, of the Australian dollar against the Swiss franc. And this is from January this year. And you can see how beautiful that trend line is. Really, really well respected. But then look at this. As the trend starts to break down, look at that retest there. I mean, that literally is perfect. And then that gives you a move to the downside, which is a tradable event. That on its own, you'll find this is cherry picked, so you'll find lots of examples of these kinds of things where it looks great on paper, but when you try it, you'll get into all sorts of difficulties as the market then trades back in, and you don't quite know where to put your stop, because that's a whole other lecture on how you would then manage your risk in this situation. But if you're looking for a very simple way, or what is considered to be an intelligent way of using a trend line as a trading vehicle in itself, that in itself will be the classic. And that is a beautiful example, really, really beautiful. useful. And the reason why people will look to trade the opposite of that is because you get fast price action. This is quite slow from a textual point of view, as you can see, but once the retest happens, the break happens, you get fast returns. And that is essentially what people are always looking for, a fast return. So there you go. That's a deep dive into trend lines. I don't know, maybe there was something in there that you hadn't really considered before. I hope so. Certainly some food for thought for everyone. So yeah, get into your trend lines, get those trend line tools out on your trading view chart and start thinking about how you can use that as a form of technical analysis to your advantage. And let me know what you think. If you've got any comments about that, or you've got any ways that you think trend lines are useful that I've not even touched on, then please let me know. I'm always fascinated to know what other people think about this kind of stuff. And that is it for today. A nice masterclass in trend lines. We have got a fantastic weekend offer on the website for you this weekend. It's a straightforward, no messing about, nice big fat 35% discount on all of the trading accounts that we've got at FTUK. The instant funding accounts, 35% off absolutely everything. And then all your challenges, your 1 steps and your 2 steps, 35% off those as well. And you can do what you like with that. Fantastic. It just turns these things into absolutely fantastic value if you want to get involved in markets for next week. And next week is going to be particularly busy because it's going to be the Federal Reserve next week. So I'm looking forward to that, especially off the inflation this week as well. That is it for today. Yeah, 35% off on the website. No add-ons included in that. So grab hold of that while that is still there on the website. Thank you very much for watching. Hope you enjoyed that. Have a fantastic week in the markets ahead, and we'll see you all next Friday.